The price of gold is up 61.4% over the last year, going back to last February, after really doing very little for decades. What is the price of gold telling us? Well, simply, it's telling us about risk that isn't yet priced in the market. And it's risk at two different levels. Of course, the traditional risk that we know about for gold, risk of currency devaluation, risk of property appropriation. Who has property appropriated anymore? I met a man, he was in his 80s, early in my career, who 3 times in his lifetime, the government expropriated all his property. It can happen. That's a fear for gold. Gold generally is just that thing you buy when you're worried about bad stuff happening. When you're worried about bad stuff happening, demand for gold goes higher, price of gold goes up. But there's another level of risk implicit in the rise of the price of gold that doesn't get quite as much press, and that's called liquidity. In this case, though, I mean liquidity being the sheer volume of investment that's chasing a finite asset, gold. Whenever you get a lot of money going after one particular asset, that demand can cause the price to go up. Hey, we saw that in something similar anyway, in the Toronto condo market. At some point, we all knew that condos weren't worth quite that much. And ultimately, we found out that they weren't. There's some of that in the price of gold. Investors were buying gold simply because the price kept going up. And as long as the price kept going up, well, they would buy more. We saw, though, that can change quickly. At some point in late January, the price of gold went down sharply for a little while as some of that speculative demand went away. So what is gold telling us? Gold's telling us that there's risk. Warren Buffett says, when others are greedy, be fearful. We're fearful. We're pulling back on our exposure to gold. We're pulling back on our overall equity exposure. If you haven't reviewed your asset mix over the last 6 months, it's time. Reach out. We're happy to work with you to review your exposure to gold, your exposure to stocks, and what could happen to your portfolio if the market does take a downturn.